Okay, good. What is it now? Afternoon? Yeah, good afternoon, everyone. Some of you will have already had lunch. Us Spaniards, we're still a bit far away from that. But thanks for attending this panel, and thanks to the EBC for hosting us here. I'm joined today by two great speakers. Jainer Sevinch, I said it right?
Yeah, surprisingly, yes.
Regulatory Counsel at Wirex and Dotun Rominiyi. Is that right? Okay. Director of Emerging Technology at the London Stock Exchange. So I think it's going to be a very interesting panel. We're going to talk a bit about, what's next for digital assets in 2024. More maybe less from like a startup perspective or when moon perspective, and more from like a more serious application and an institutional perspective. So the first question I want to ask both of you, and whichever of you can start, but it's which challenges and milestones do you foresee in 2024 from a regulatory aspects? What things in terms of regulatory changes are you looking forward to, and what things are you still looking at, like, is this going to go the right way, or is this going to become a hurdle for the businesses you are concretely in and for the industry in general, right? So
maybe I can start with that. Since I've been involved in this space, this question stands still. Is regulation gonna kill the innovation in the blockchain space? I definitely don't believe that way, and there are many important regulations coming in. Needless to say, people have already talked about MiCA coming into space. In the UK, we will see a more robust, more extended regulation similar to FMSA, framework. Some of them already in place, like travel rule and financial regulations regime, which are very important for UK and US perspective. But I would like to speak because as from Wirex perspective, we are working on other areas than UK and EEA. We are in US, we are in Australia, we are in APAC, and we see not only in UK and US, but every jurisdiction is extending their regimes in terms of regulatory compliance. So what does it mean? In the shortest sense, it means that it is bringing trust to the to whole industry, because robust regulation will mean more risk management. Robust regulation will mean real controls being in place, which are very vital for, I think, individual trust in the sector. And this will be the main key, I think, from regulatory perspective. What could go wrong with that? I think almost nothing. What could go wrong is a risk for companies who doesn't have the appetite to be complained. Companies who doesn't have sources to be complained. I think only risk that these robust regulations possess is just maybe a conciliation area or time for smaller companies who doesn't have the appetite or resources to comply.
I totally agree. I think one of the interesting aspects of regulation, and maybe speaking first about the crypto side, and then I'll talk a little bit about the sort of tokenization side of more traditional financial instruments. I think certainly on the crypto side, when we see sort of the materialization of MiCA as largely the sort of world's first fully comprehensive framework for digital assets, what it brings with it is certainty, right? It's certainty for businesses that want to scale services in this market, certainty for investors, certainty for intermediaries, and that's a really important factor. If we think about sort of some of the signals we've seen over the years in the crypto space, we saw sort of over the last bull run a lot of institutional demand for crypto and a lot of friction around large institutions being able to step into this space. But they're very risk averse. When you're a heavily regulated financial markets organization, you have certain obligations that you need to make, and it becomes very difficult to enter into markets that don't have that certainty. So I think that's a big piece. I mean, if you look at, in terms of scale, crypto today is shy of $1 trillion market cap in terms of size, whereas listed equity globally is 112 trillion. and that's just listed equity. So I think there's a lot of opportunity to see institutional capital flows come into the crypto space, but what you need is that sort of regulatory framework to provide that sort of underpinning that gives certainty to some of the larger institutions to actually then start to make waves into that space. And then moving away from crypto, certainly we have seen a lot of interest in the pilot regime in Europe and how that's taking shape, and certainly in the UK with the announcement of the FMI sandbox, should I say, largely providing a means by which companies like us at the LSEG can look to adopt these technologies to try to drive new infrastructures around how we build greater efficiency in our more sort of traditional markets. So looking at private assets, looking at opportunities to enter into spaces where today there isn't a lot of infrastructure full stop, where there's a lot of fragmentation, there's still a lot of sort of paper-based manual processes, where literally by digitizing, let's say, a private fund, for example, you can take settlement times down from 30 days, 45 days, to a day and even shorter, and that can itself drive opportunities for liquidity provision and scaling of demand for some of these instruments. So I think there's a lot of opportunity there, and I think the basis of how that innovation can really start to take shape is really predicated on regulation.
I agree. We get a lot the question in crypto of like, how is crypto driving value for real world applications? Like, what has crypto done to provide real value and so on and so forth? And there are things that you can do in purely like digital, purely DeFi, etc. But if you want to add value here, like in the physical world, you got to play by some rules in the physical, and those need to be set. And enough time has passed that regulators know crypto to be able now to generate frameworks that are able to attract all of those assets that currently live on chain and tokenize them and really leverage digital assets. And it's great to see that London Stock Exchange Group is betting into this. What are and this is maybe an opportunity also where I would like maybe both of you to explain, like, I don't think you need to explain what the London Stock Exchange does, right? Because I think that's pretty clear. But what are you doing with digital assets, right? Why is it something you're exploring? And in the case of Wirex, right? Like, what do you guys do? How do you integrate digital assets into your operations?
From Wirex perspective, digital assets has been always the heart of Wirex. Wirex was established as a crypto-first, crypto-native firm, also providing payment services. And it was founded in 2014 and was the first company that actually got the principal MasterCard membership as a crypto-native firm, and has been providing payment and crypto services since then in many jurisdictions. That being said, that crypto has always been the heart and center of Wirex, but Wirex has been exploring also new Web3 applications, DeFi, or like, for example, non-custodial wallet and other DeFi applications as well, together with more complex products that could also attract not only exchangers or individuals, but also sophisticated investors can also get into Wirex platform and make a use case. So that's been Wirex center, and that's why started with only with Bitcoin, because when Wirex was started, Bitcoin was the only star, but now over 100 tokens and over maybe 200 different products, users can really bring digital assets in their use cases as they wish. So this is what Wirex has been doing.
So what are we doing in the digital asset space? I mean, largely as an organization, again, I don't need to explain what the LSEG does, but I mean, our bread and butter is in providing what we call financial markets infrastructure. So, it's sort of mission critical, enterprise grade, critical national infrastructure that powers, the financial markets and economic systems. Our focus with respect to the use of this technology is largely looking at how can we evolve our business? How can we evolve the way in which markets operate and the way in which customers transact in and around financial securities? We see there's a lot of opportunity, specifically when we look broadly across various asset classes, to think about this problem through the lens of a common set of technologies that enable us to digitize instruments, manage their life cycle end-to-end on a common common ledger and then provide services against those assets in a largely ubiquitous way. DLT provides a really great way for us to think about that problem. We think about some of the operational efficiency gains around administration of assets, asset servicing, distribution of cash flows and funding with respect to whether it be coupon payments in the case of bonds or whether it be dividend payments in the case of equities, and certainly opportunity to scale and grow liquidity through efficiencies and settlement too. So these are some of the key areas for us. I think the other lens that's interesting is when we look across the space, clearly there's been a lot of investments by large-scale institutions in this market specific to tokenization. There's been scaling and sort of maturing of specific platforms, but largely these are led by individual institutions, banks, and it's hard to scale beyond one's own ecosystem. I think one of the benefits that we have today is, we are largely, a service provider to everyone in the street. We are a neutral party. We build and convene markets. So it creates a great opportunity for us to look at this landscape and sort of see a positioning for us to bring the market together. Can we think about interoperability? Can we think about standardization to really help scale an ecosystem and scale liquidity through that?
Dotun, it must have been quite a challenge, to lead this initiative in a company where probably many of your competitors or peers, some of them even see it as a threat. Some of them, don't believe it. Like, what's from a personal, professional learnings? What's the experience been so far? What learnings have you found? What things, as much as you can share, of course, but what things didn't work in terms of the learnings you've taken from trying to implement this frontier technology into a business that has been doing pretty well without it so far, right? And how's that been?
I mean, us, like many institutions, it's we've been on a journey, right? I would say there's sort of two interesting areas with respect to that we sort of experienced. One is largely, as many other institutions have sort of gone through, it's the education problem. For the longest time, we've seen a very close correlation in terms of sort of the perceptions of blockchain as a technology with crypto assets and all of the associated reputational constructs that come with that. I think, thankfully, the landscape has moved on. I think what's become very clear through, multiple sort of series of POCs over the years by other institutions, as well as our own, it's really helped to solidify that understanding that actually the technology has application beyond the sort of esoteric crypto assets you see in that ecosystem. And even engaging in that ecosystem, there is an interest for us. We have FTSE Russell indices on crypto today. We're exploring other products and services, largely on the periphery of our business. But I think the other sort of interesting point to the journey for us has also been thinking about where should we play and where is our right to win. And it's really around, we are providers of mission critical infrastructure today. Certainly when we look at sort of where we have the most impact in that space, it's largely sort of public markets. That's sort of our bread and butter. Where we think there's a lot of opportunity for us is, can we see this as a growth strategy, potentially, to scale our business and scale infrastructure into markets that don't yet have that? And we think that's a really interesting opportunity, looking at private assets, private asset classes, et cetera. So, that's been sort of a key part to some of our analysis and some of our thinking, and we've been, validating some of these ideas with market players and sort of exploring where we go. I think there's a sort of key aspect to this that's really around if you can build a single technology similar to what you see in the Web3 space that allows you to define a sort of common infrastructure that can support multiple asset classes, that then becomes really interesting. If you contrast that with the sort of legacy model of largely siloed infrastructures on a per asset class basis that's sort of extant in the market today.
And Jenner, you guys at Wirex, it's not like you are, building something that didn't exist before. You have decided to take on some of the largest companies in the world by leveraging digital assets and leveraging blockchain technology, which it's easier said than done, of course. So I think that has a lot of merit. What has digital assets, blockchain enabled you to do that legacy players are not able to do? What edge is it giving you? And also, it's a second question, but what role are you playing in bringing mainstream non-crypto native people to digital assets?
Yeah, sure. I think that's very interesting from two perspectives in my mind. First, what actually Wirex did was to first, not maybe first thing, but first established, cryptos could be like very well used in daily payments, like buying a coffee, buying yourself a beer or a croissant, and Mastercard and Visa partnerships allowed Wirex to do that quite a while ago. Now it's not a secret. Many companies can do that as well. But apart from that, Wirex has established himself as a very trustful source for using inventing new use cases. And that's what actually made Wirex survive at least 2 crypto winters, if not 3, because unless you are good at bringing new people into space, using new cases or like using trusted bands, like for example payment companies like Mastercard and Visa, to gain individual trust into crypto. You can't establish that. It's simple. For example, a very simple example that I can give, that my mom and my dad, they wouldn't buy Bitcoin if they didn't have a card to spend on that. But even if you teach them how to buy, they wouldn't buy because they wouldn't know how to use it. But now with the use cases like Wirex and many others within the industry, now there's a chance that you can gain trust from these people to bring them into space, and maybe they can like it and do much more.
Yeah, I agree. I think sometimes, we're too much at the frontier of innovating in the technology, and that is good for all the people who are in that frontier, but then you have all the mainstream users, and you really need to think about, okay, all the crazy things we can do, it's good to research them and to know how to do them, but maybe we need to leave them for a bit later and do a middle step, or we do a bit of a bridging, and then we will bring these people to that frontier, to all the crazy things that you can do after that, right? And staying on that part of innovation, maybe Dotun, what innovations in the technology are you, and in the space, are you looking forward to? What challenges are you foreseeing for institutional players such as you, or the ones that you work with for the future? There's a lot of technologies that are coming up, from zero knowledge proofs to others that maybe are not as related to what you guys are doing, like account abstraction and so on, like modular blockchains, like layer 2s and scalability, like dank sharding, and all that stuff. But what are the things that you guys are looking forward to the most, and what are the things that you're the most scared of for the coming year or two?
Good questions. I think given sort of our unique position in this space, I think there are sort of maybe a certain set of problems that we would need to grapple with. If you're providing infrastructure to large banks who are going to be issuing billion-dollar assets, there's a certain level of sort of resiliency, security, robustness in infrastructure that we need to think about. One of the big challenges with sort of looking at this technology is when you look at the sort of public chain space, that there is a nascency in and around these technologies and their ability to solve for those types of risk profiles. Certainly, even the volatility of gas is a big problem operationally for a large enterprise to be able to manage their operational cost, which today, from an infrastructure standpoint, would largely be relatively stable, but then becomes very unpredictable, and you need to think about how you're going to layer sort of risk management and hedging strategies into your ops profile from a treasury perspective. It's just something that a lot of institutions are just not familiar with. So I think for us, the key is thinking about, where do we start and then where do we get to? Certainly for us, we see there's value in public chain when you think about that from a sort of distribution and access perspective around getting access to these instruments. But we think there is a clear need to start with a narrower scope, more control, so potentially a private network, but certainly looking at the types of technologies that are consistent with the public ledger space. And I think there's an evolution. And if we think about some of the innovations in this space that are interesting to potentially get us on the way there, I think roll-ups is interesting. I think especially on the ZK side, some of those innovations will really help us think about how do we build private networks that define canonical assets where you can then synchronize the sort of a synthetic mirror of those instruments across multiple ledgers, scaling all the way up to public. that therefore you can provide sort of core services with high-grade, non-functional requirements on a layer of trust with assurance, and then you can then scale into provision of access and distribution at a much more broad layer. So there's interesting models there, right, that we'd like to explore as the market evolves. Certainly the other aspect that sort of credentializes this thinking is privacy for us. Certainly, large institutions transacting, regulated capital flows and activities, they don't want their competitors to see what they're doing, even insofar as they don't even want visibility of the transactions to be made available, because it provides a sort of correlatory signal to other market participants. So I think it's clear for us that these are problems that are very hard to solve, privacy being a big one, and certainly in a commonalized way across different technologies. So our thinking is let the innovators in the Web3 space continue to evolve these innovations to solve these problems, and we'll use more pragmatic means to sort of hedge ourselves, but also keep the optionality open over the longer term to be able to leverage them.
The good thing about that problem, I think, is that both institutionals as well as like the most crypto native, probably the one frontier where everyone's most focused on for different reasons is privacy, right? Sure. One is more of a ideological reason, the other one is more of a practical reason, but I think it's probably where most of the research will go into in the coming years, now that scalability is seemingly not there yet, but solved at least theoretically, right? Jenner, you guys are a very different beast, of course. What are the innovations, that you're looking forward to the most, and what are the challenges that your business is looking forward the most? Not looking forward the most, dreading more.
Yeah, no, I don't think that, me personally, nor Wirex would be afraid of any innovation, because, we have seen this space is growing through innovations, and, you throw 1,000 ideas and then, 2 of them works, but this is how the system grows actually, and especially in the blockchain space. But we are particularly interested in new DeFi payment cases that Wirex can bring experience into, because it's been on traditional payments and crypto together for a while, and then DeFi and blockchain-based payment systems like specialized chains are something that definitely will be interesting in next couple of years, I guess, for us.
Yeah, and that's definitely also an edge you can keep over your competitors, right? I mean, there's a product portfolio or product options you can give that they can certainly not give, right?
Yeah, exactly. I think you need to be stay ahead this pace, and it's not easy in this space.
Yeah, I don't think we can talk about what's next for digital assets and not talk about the CBDCs, right? Which is a hot topic, and I'm gonna put you on the spot, Dotun, here. What's your take on CBDCs? You're probably gonna win 50% of friends and 50% of enemies, or something like that.
Probably no. I mean, I think CBDCs, it's an interesting area, right? And I think that there's a lot of sort of divided views on the sort of viability and efficacy of sort of the proposition. I mean, I look at it through 2 lenses. You have the sort of, on the one side, the retail lens, which is it's all about how do you scale an infrastructure that doesn't break the existing economic model, largely, right? You think about how banks provide a pivotal role in how central banks administer and manage monetary policy. And if you bring in an infrastructure and a provision like CBDC that may undermine that in some form, that may have unanticipated knock-on effects, right? So I think that's a key area of interest for policymakers, central banks, and how they think about the designs of CBDCs to try to solve. Privacy is the other very significant consideration, but more so just the value proposition. I mean, I don't think that's really been crystallized yet in the context of sort of retail, where I think on the opposite side, you have the wholesale angle, where I think it's very, very clear that CBDC has a very strong proposition for large institutions that are transacting in large-scale capital flows, where today this is driven through centralized RTGS infrastructure delivered by the central bank to the market through large-scale intermediaries like central securities depositories. If you can facilitate a much more distributed infrastructure to allow for the distribution of M0 money that's effectively riskless into the sort of wholesale markets, it provides a lot of interesting opportunities for use cases and scaling those use cases more broadly to hedge for certain types of risks that exist in those ecosystems. And certainly from a an efficiency perspective, when we think about digitization of financial securities, having the opportunity to have the cash on a similar or common infrastructure, again, creates really, really unique and interesting efficiencies there too. So I think from an institutional perspective and on the wholesale lens, there's a lot of opportunity. And I think the proposition is clear. I think on the retail side, less so.
Yeah, I agree. I think it's one thing where crypto natives, from a retail lens, were not the biggest fans of CBDCs, but then at the same time, like one thing that many of us believe as well is that the CBDCs create a bigger need for, not all token classes, but at least the cryptocurrency token class, right? Bitcoin and so on. So it can be its biggest enemy and friend at the same time, but it's definitely a hot topic. Thank you very much, Janner and Dotun. It's been a great panel, and thank you all also for attending. And we'll see you all around here at EBC.